Okay, so most importantly, can everyone see my screen? Can we just get a confirmation that everyone can see my screen? Mark, Drew?
Yeah, we can. Yeah, we can.
All right, perfect, perfect. So let's get right into it. The first thing I need you all to do, head over to indicators, and I need you to search DR/IDR version 1. This indicator is very necessary. You need it as this indicator marks out very important ranges in each session that we use to dictate our bias for that session. So everyone go ahead and open up your trading view, open up indicator and search DR and IDR. Once you've opened up that indicator, I want you to go ahead and open up the settings. Let's set it all up before we get into how to apply this indicator and make use of it. So now that everyone has their indicator settings opened up, I need you all to ensure the timing of your indicator is as follows. So the main important thing is the RDR and the ODR. We don't trade during the Asian range, so it's not really important that this is accurate. The main thing is that the RDR time is between 9:30 a.m. to 10:30 a.m. This is all in New York timing, by the way. You guys can see right here. The settings on my chart always is within the New York time zone. So all the timings that you see here is basically the timing during the New York hours. So RDR starts at 9:30 a.m. to 10:30 a.m. Then the ODR, which is from 3 a.m. 4 a.m. ODR stands for overnight defining range, and RDR stands for regular defining range. Overnight defining range is basically the overnight session in New York, which is London Open. London Open to all of our new United States people out there. It's basically your London session is midnight. For us, our London session is our morning. So that's why it's 3 a.m. to 4 a.m. Oh, sorry, the settings is gone. But that's the timings that you guys need. Very, very important. RDR 9:30 to 10:30, ODR 3 to 4 a.m. Okay, and if we scroll down, you guys can tick off the after. It's not necessarily important, but we don't trade the Asian range. The main thing is you have the regular, the overnight. Show the DR lines, make sure that's ticked. Show middle DR line, unnecessary. Show IDR middle line, necessary. Make sure that's ticked. All labels, and yeah, that's pretty much it. You most likely have the extended one and show STD line also ticked. You can untick it. It's not really that necessary. Okay. Once again, the most important thing, you need to make sure your settings has the right time. So 9:30, 10:30, 3 to 4 a.m. Make sure these are ticked. Every single one that's unticked, you can also do as I have done, as it's unnecessary to have on your chart. And you can get rid of show the standard deviation lines, as I personally don't use standard deviation when it comes to TP setting. Okay, that's the whole purpose of standard deviation, is to target one standard deviation, two standard deviation. That's something that I do not do. Okay, so now that you guys have the indicator ready and the settings done, let's go ahead and break down how we actually apply this indicator to our trading. So defining range. So with DR and the IDR, what does it stand for? DR stands for defining range and the IDR stands for the internal defining range. So before I break down the drawings that I've done, this is the indicator on the chart. And I'm going to show you guys the difference. So this is the ODR and this is the RDR, this being the London session, this being the New York. One thing you guys have to be familiar with is the IDR and the DR. Very, very important. The IDR marks out the body high and the body low of the first hour's range of the London session open. And the DR marks out the wick high and the wick low of that range. That's the difference between the DR and the IDR. The IDR is body high, the DR is wick high, and obviously the DR is wick low also, and the IDR is also the body low within that session. Okay, now the ODR. 1 second. Let's go back to our examples right here. So the ODR marks out the range between 3 to 4 a.m., which is the first hour of London session open. Why is this a very important range to monitor? Now, the idea behind this concept is the first hour of each session open usually delivers into the direction of where price wants to go for that session. So what we would let price do during the first hour of each session open is we will let it play out and we will monitor this range. And that is what this indicator does, is it marks out the first hour of each session open and it marks it out as a range. What is very important to us is what happens outside of this range, as what happens outside of this range is what gives us our bias and our overall direction for that session. For example, this is our ODR, which is the London session first hour range. So market opens, first hour plays out. This is the price action that happens between the range. This is the body low, the body high, the wick high, and the wick low. Now, why is this an important range to monitor? As what happens after is what determines our bias for that session. Remember what I said. So note this down. What happens after the first hour range is how we dictate our bias for that session on the 5-minute time frame. Okay, so make sure you note that down, as it is very important to understand that what happens within the first hour isn't that important. It's what happens after the first hour's range, which gives us our overall directional bias for that session. So let's assume that this was the price action within the first hour of the London Open. Second hour of the London Open begins. Price begins to continue to consolidate. Eventually, it breaks bearish. So this was the wick low off of the first hour range. Price ended up closing bearish outside of the first hour range. The second price closes bullish or bearish outside of the first hour's range. That is your bias. That is now your direction that you are focused on targeting for that session. So now that we've had a bearish break outside of the first hour range, all we begin to look for now is areas to enter a selling position from, as we are no longer interested to buy that instrument. Okay, so now that we've had a bearish break, we start to identify areas of supply with whichever high was printed is officially the strong high that we don't expect price to breach. Whatever I'm saying right now, guys, will be broken down on charts so you guys can see it visually and understand it a lot more better. But the main thing that I want you to grasp for what I'm saying right now is whatever happens after the first hour's range is what determines your overall directional bias. So all you need to understand is now that the second hour has begun, it eventually began to break bearish outside of the first hour. So now our directional bias for that session is that we are bearish. Now that you guys understand is what happens after the first hour's range that determines our overall bias, let's go ahead and show you guys an example of trades that was taken on the pound against the dollar using these concepts. So this is traded always on the 5-minute chart. Okay, so when trading and using the IDR, the DR and the IDR indicator, make sure you are on the 5-minute time frame. So London has opened. You guys can see this is 3 a.m. to 4 a.m. This is the first hour of the London sessions range. Let's zoom into that and identify what has happened. So now that we've noticed right over here that price has formed the range of the first hour, and then it was followed by a bullish closure above the DR line. So we had a bullish closure to the upside, which closed higher than the wick high that was formed during the first hour's range. Now, going back to what I was saying, it's what happens after the first hour that confirms our directional bias. So now that we've identified the first hour's range, the candles that followed from the second hour onwards ended up forming a bullish closure outside of our first hour's range. Therefore, we have now confirmed we are going to be bullish for our London session. Therefore, the second we've had that bullish closure to the upside, I am only looking for areas of demand to buy up from. I'm no longer interested to look for sells, no longer interested to go for any shorts. I'm only interested to buy up this pair. Okay. Once we've had that bullish closure as well, this confirms that this is the low that will be most likely held. All right. And we won't be expecting price to be breaching this low as we've had that bullish closure. So we are now working with whatever price action we have within this price range between the low and the high that was created. So if we replay price back to this point, this is exactly what the chart had looked like prior to the pullback into our levels of demand. So the first thing that we identify as soon as we got that bullish closure is this initial level of demand that price eventually pulled into, mitigated from this point. And then for when it comes to TP setting, that's when we start to include liquidity concepts, areas of inefficiencies, and understanding overall discounts and premiums. Okay. So for this instance right here, we target opposing liquidity. Now, you guys hear me talking about a very important concept, which is the use of the power of three. This is something that is very important for you guys to understand, as it is one of my A+ setups. Now, the idea behind the power of three is that the Asian range holds liquidity on both the low and the high created during that session. Therefore, when London had opened and it took out the Asian low, we also expect there to be liquidity resting at the Asian high. Therefore, when we had that bullish closure to the upside outside of our ODR, we started to look for areas to buy up from to target the opposing liquidity. So once we identified this level of demand and we play price, you can see we had that mitigation into our level, and price eventually had swept these Asian highs. That was this trade broken down in the most simple terms. We've basically had a bullish closure, price pulled back into some deeper discount, taps into the initial level of demand, remitigates into that level. We execute based on that mitigation and we target opposing liquidity. And that's basically how we trade this system. Now, that's the London DR explained. Now we're forming the New York DR. So let's pay attention to the price action that happens right over here. So overall, we knew for the London session, we were bullish because we've had a bullish closure above our DR high, which gave us our directional bias. We identified our level of demand where we entered into. That's where we bought and we targeted opposing liquidity. That's the London session now done. We've executed this trade, left with a 1 to 4. That's 4% made on just trading the London session using this concept. Now the New York DR has formed, which we call the RDR, the regular defining range, has now formed. Okay, and this forms during the 9:30 and the 10:30 a.m. timing. Notice what's happened right over here. But before we do that, let's analyze this overall price action. So once price formed this high, it was followed by a low. It was then followed by a lower high. It was then followed by a lower low. So technically speaking, within this price action right over here, we've had a shift in trend here on the 5-minute, but there was no trade being executed, as remember, we only trade after our defining ranges have formed. So whatever price action happened here is all irrelevant. It's what happens after that means everything. So now that the 9:30 and the 10:30 a.m. window has completed, we simply wait for price to break bullish or bearish outside of this range that has been formed. And notice what happened with these two consecutive candles is it eventually broke bullish, closing above the wick high that was formed during the RDR. And just by understanding overall order flow, you can see high, low, lower high, lower low. This was the high that formed this low. So when price breaks through this high, that is our confirmed change of character. So without even making use of the DR and the IDR, just by going based off simple price action, you can simply identify that price has shifted as it took out the high that formed this low. That was our change of character. You now look at your levels of demand and you can simply trade of that. But adding that extra confluence of the DR where you know price has broken bullish outside of the RDR range, you know you have your confirmed directional bias just because of that break. So now that price has closed bullish outside of our RDR, we simply identify the next available level of demand that we can trade of. And this was our level of demand right here. And when it comes to trading this level of demand, you simply target the next high so this was the high that was formed. Our overall directional bias is bullish. So when we look at overall price action here, this was the low, high, higher, lower high, and then higher high. That's what we're expecting price to print. So when it comes to TP setting, we're simply targeting the highest high as we're expecting price to breach that point. Eventually, price mitigates into our level of demand. That's where we execute our position, and we simply target the high that was created during the London session. And as you guys can see, takes a while to eventually play out. But we do end up getting TP right into the high that we were targeting. This trade does eventually swing over to the next day as we ended up hitting take profit during the Asian session. So I hope you guys can grasp the idea behind how we apply DR and IDR. It's very, very straightforward. Is you use the indicator marks out the range for you, but what happens after the range is formed comes down to your analysis. So once you had that bullish and that bearish break, that's when you start to apply the concepts that you already know, which is supply, demand, liquidity, and efficiencies to identify your levels of supply and demand. For instance, this area right over here. We understand, yes, we had that bullish closure outside of the range, but even without that bullish closure, we know price shifted in trend. We moved from printing a series of lower highs and lower lows into breaking that previous lower high, creating a new high. We've now shifted the market sentiment from bearish back to bullish. Price created this inefficiency. When there's a level of inefficiency, we know that price needs to fill those levels. What ends up happening? Price begins to pull back to fill in this level of inefficiency. This was the last available level of demand that was left unmitigated. Price mitigates this point, and we target the highest high as we're expecting price to follow this overall order flow. Okay, so the concept of the DR and the IDR gets applied to your strategy of supply and demand. It's just an addition to what you already know to confirm your overall directional bias for you as something that I have identified. And it is the biggest weak point that a lot of people have when it comes to trading supply and demand is struggling with having a directional bias. The second you get your directional bias wrong, is how you begin to lose way too much. By having an understanding of where we are heading, you are less likely to take the wrong trades, trade of the wrong zones. Okay. So having the DR and the IDR concept just allows you to have that extra confluence with understanding your bias for that session. And let's go ahead and show you guys another example of a trade that was taken on NASDAQ. This was a trade that was actually posted on Instagram. I don't know if you guys remember, on my previous trip to Marbella, we took these shorts and I posted it live on Instagram for you to also execute this trade with me. But the idea behind this trade was very, very straightforward. Very straightforward. Let's head over to the hourly first so we understand the overall price action that was happening on the higher time frame. So you guys can see there was all of this inefficiency right over here that eventually price had to fill in to create that balance to provide both buyers and sellers an equal opportunity to liquidate the market. So once price began to pull back and mitigate into this hourly level of supply, that's when I started to monitor price to look for areas to enter from on the lower time frame. That's when we shifted down over to the 5-minute. Okay. We needed a change of character to confirm that price was actually going to hold at this level of demand. So once it re-mitigated into this level of supply, this was the last low that formed the high. So we need needed price to break this low to confirm the shift. So because this was the low that formed the high, we waited patiently until price eventually broke bearish outside of this low. Once we've had that market structure shift, you guys can see very nicely we have this very beautiful distribution schematic that had played out. Price tapped into supply. You can see that weakening in volume. We've had that major sign of weakness right over here, and the last point of supply right over here. So going back to what Zahab was teaching you guys, this can now be applied over to this chart over here. You can see the Wyckoff distribution that played out as price mitigated into this level. We've had that major sign of weakness, tap into last point of supply. If you were trading Wyckoff, you would have initially entered right off of that point, which you can see mitigated during the London Open. So this would have been a beautiful execution purely using supply and demand and Wyckoff. But with the use of DR and IDR, obviously we need that further confirmation, that extra confluence to confirm that we are going to be bearish for that session. So you guys can see this was the formation of the ODR, the overnight defining range, which is the London session's first hour. And as you guys can see, what ends up happening after the first hour range is formed? Price consolidates a little bit and it ends up closing bearish below the DR low, meaning for that session, we are now bearish. We are from the high that was created from the first hour into the low that was printed. We are looking to sell within this price range. This is the price range that we are now working with. So the first thing that I identified once we've had that bearish closure is these two levels of supply. Okay, but once we start to get that pullback, that's when you start to use more and more confluence to dictate which level of supply and demand am I actually going to be executing from. That's when we start to understand discount and premium pricing. That's when we start to make use of our Fibonacci tool. So once price has broken bearish, we understand that this is now the strong high. So we begin our Fibonacci tool from that high into the low that was printed right over here. Okay. And with the understanding of discount and premium, you know, we only like to sell at premium and we like to buy at discount. Meaning, when it comes to looking at levels to sell from, we're not interested in levels of supply that align with our 50%. You never want to sell at an equilibrium. You either want to sell at the most expensive or you don't sell at all. Okay. So when we identified these two levels, the first level of supply was in line with our 50%, our level of equilibrium. This isn't a level to be interested or you should be considering a probable level to be selling from, as it is not expensive enough for people to be profit taking at these regions. So you expect price to dip into some more heavier pricing to then look to short. So we have this level of supply where there's also a bit of inefficiency. This level of supply is perfectly in line with our 79 and 88.6%, which is deep into our premium levels, meaning this level of supply is a lot more probable than the level of supply that aligns with our equilibrium. Therefore, when price began to pull back into these levels, we set our limits at this more premium level, which was shared on Instagram, by the way. I don't know if you guys remember this trade. It was a few weeks back during my trip in Marbella. Price mitigated into this point. As soon as we had that mitigation into this level of supply, we simply execute and we target the low that was created. As remember what I said, once price breaks out of this range, this is the range that we're working with. So the level of supply is at the premium and our take profit is at the low that was created. And as you guys can see, we had that perfect mitigation, sniper entry off of this level of supply that aligned with our 79%. And we came into the lows that was formed during the London session. That's all there was to this trade. Very, very simple concepts that you guys can apply to the strategy that you already have to give you that extra edge and that extra confluence to confirm your overall directional bias for that session. So that is my times up. Unfortunately, I can't give you guys more than I